Hi everyone, and thank you for tuning in. In this video, I'm going to go over Nike's fiscal 2023 first quarter results. The company announced earnings yesterday, September 29th, after the markets closed, and today the stock is down 12% on the day following the announcement. So let's look at what investors did not like about Nike's earnings report. So they're going from shortages to surplus. That's the headline of the earnings report. That's my, recap of it. Overall revenue, however, increased by 4% to 12.7 billion in the first quarter. This is despite some pressures from currency headwinds. Revenue would have been up double digits if we were just looking at it in constant currency. And this was for the quarter that ended on August 31st. So earnings per share of 93 cents in the first quarter was down 20% from the $1.16 it earned at the same quarter last year. But here's the headline. Inventories at the end of the first quarter are 44% higher than the same time last year at 9.7 billion. That's a whopping figure. And if you recall, this same time last year and in really all of last year and most of 2020, Nike was complaining that it didn't have enough inventory to meet the robust customer demand. People were going to Nike's website, were going to stores that carried Nike's products, and they were finding that their products were sold out or in limited supply. This was a shortage problem that plagued the entire apparel industry. There were several companies that were experiencing the same thing. These supply chains have relatively eased now here in 2022, and now we have several retailers, Nike being one of them, that has more inventory than they would like. I also follow Target and Walmart, and they noted that their inventory levels are also incredibly higher than last year and also much higher than they would like it to be, because consumers have shifted their shopping behavior from the things we were buying 6 months ago, 12 months ago, 18 months ago. Now consumers have shifted their behavior to spending money on things like going out to restaurants, going to concerts, traveling, getting on a plane and visiting family. Things that we did not do so much of during the earlier lockdown phases of the pandemic. And so that's left retailers that sell physical goods like Nike, like Target, like Walmart with too much items, because consumers are not buying those kinds of things anymore either. So one consequence of this and why this is troubling is because it's going to impact profit margins. If you have all of this inventory as a business that you see is sitting on your shelf, you're going to need to offer customers an incentive to buy it. You're going to have to give them a coupon. You're going to have to give them a promotion. Things like buy one, get the second one 50% off, or 40% off this size, or 25% off if you spend $50 or more. Things like that might increase customers' willingness to buy your item, but that's going to hurt your profit margin. Already in this first quarter, which ended August 31, Nike's management noted that gross profit margin fell 220 basis points to 44.3%. To make matters worse, management highlighted that there's more pain ahead, more pain to come. They need to continue offering discounts and maybe further discounts to try and relieve themselves of all of this extra inventory. And to make matters worse, they're doing that at the same time that other retailers are also offering discounts like Target and Walmart and Macy's and others. So they're lowering their prices, but customers are seeing lower prices throughout the industry, so they're able to choose from maybe other lower priced items, other discounted items. So these discounts may not create the increase in sales that Nike is expecting, because customers are also seeing similar discounts at other stores. So relatively speaking, when a customer sees an item for sale at Nike and they compare it to an item for sale at Macy's or Target or Walmart, they're going to say, that's not, Nike's product is not that much, it's not that much cheaper than what I can get it at Target. Or maybe the item at Target is much cheaper than what Nike is selling it for, and so the customers might choose to buy from Target instead. So this is not good news for investors. This is not good news at all, and you can start to understand why the stock was down double-digit percentages on the day following the report. Management also gave the fiscal year 2023 forecast, so what they expect revenue and profits to be for the rest of the year. And the revenue outlook still remains strong. Low double-digit revenue growth is expected for 2023. However, they did indicate that profit margins are going to compress. They're going to decrease because of all of these sales, all of these discounts and promotions that they're going to need to do, as well as others are doing. And so that increased promotional activity is going to bring down profit margins. And Nike is not saying this is only a 1 quarter thing. They are saying that this is going to be an all year problem, that this is going to sustain throughout the year. So that makes it even worse. And all of this, of course, is due to the elevated inventories and the change in consumers' shopping behavior. And this is something that I expect to persist for the foreseeable future. I would say at least 2 to 4 quarters. That's what I'm seeing from several of Nike's competitors and also other brick and mortar retailers that are seeing these same trends, and CEOs and CFOs are forecasting a similar outlook for the rest of the year. So it doesn't look good. It doesn't look good for Nike in terms of profit margins for the rest of this year, but that's no reason for shareholders to panic. Over the longer run, Nike has this tailwind at its back that's expanding profit margins, which is the fact that it's cutting out middlemen in the supply chain. Previously, Nike dealt with a lot more wholesalers where it would sell them their products at lower prices, and then the wholesaler would deal with the consumer and sell the products to the consumer. Nike has said, you know what, let's cut out that middleman. Let's just sell our products directly to the consumer, and that way we can earn higher profit margins because we don't have to deal with the wholesaler in the middle. So that trend has been ongoing since 2019, and Nike's been successful in implementing this. The app, the direct-to-consumer app, and Nike Direct sales has been increasing robustly. So at least it has that tailwind at its back to kind of offset the impacts from the promotional pressure on gross profit margins. So for this year, although for this year specifically, the impact from sales is going to outweigh the impact from going direct to consumer, but going forward, 2024 and beyond perhaps, Nike's gross profit margins can continue to expand and recover the losses they incurred here in 2023. Okay, so thank you for watching in this segment and this earnings review. I'll see you next time for the next company I will review, and thank you for watching. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.